Hello, welcome to Policy Pod by LDA. My name is Matt Gauthier and I'm your host. This podcast aims to break down common trends, problems, and concepts in the life insurance market. We wanted to create a place where we could talk openly about the things that confuse both clients and advisors alike. On today's episode, I was joined by Henry Korenblum, Vice President of Sales and Tax Planning at Oberon Capital Corporation. Henry came on the podcast so that we could discuss the upcoming changes to Canada's capital gains tax laws and the effects that will have on life insurance industry and life insurance advisors. Henry is a trusted and highly experienced consultant to accomplished business owners and affluent families on matters associated with transition and wealth. He helps guide families through the unique opportunities and challenges they may be facing in the areas of wealth, tax estate planning, philanthropy, family governance, and business succession by planning and taking time to thoroughly understand specific goals and objectives. In addition to being a chartered professional accountant and a chartered accountant, Henry is also a chartered investment manager, a certified financial planner, a trust and estate practitioner, a master financial advisor, a philanthropy, a master enterprise advisor, and a U.S. certified public accountant in Illinois. I'm just going to start out by reading off a few headlines here. Okay. So when I searched Capital Gains Tax Canada in Google, the top headlines: family cottages, the impact the capital gains tax changes will have. Liberal table, capital gains, what you need to know. How should you prepare for the changes? Liberal government takes steps. What does this impact you? I understand from a marketing point of view, these companies know the headlines. They know how to SEO those headlines to get the people, to get the articles in front of your eyes. The interesting thing I'm finding is that the consistency, regardless of what the outcome is going to be, the consistency is, what is it that matter to you? Because if you're looking it up on Google, they know you are the person that's interested. So let's start with talking about that and say, why is this the best time in the world for insurance advisors to talk to clients? Like, people I think this is maybe one of the only times in life insurance that people actually want to go out of their way to talk to their insurance advisor because of these upcoming changes. So let's talk about that, and then we'll talk about the changes to the industry. So legislation was tabled last week, and it is now in fact going to happen on June 25th. Correct. The capital gains is going up from 50 to 66.7%, I believe, or 67%.
Two-thirds, correct. 66.67%, correct. In most cases.
Which is a 32% increase on the total tax you would take. They're also increasing the lifetime exemption amount to $1.25 million.
On this lifetime capital gains exemption for qualified small business corporation shares, QSBC shares, which is the welcome news for business owners who want to, once again, structure their affairs to optimize for those potential sale events. So absolutely, that's welcome news. Please continue.
So where is this going for? What's the target of this? Like, what was the reasoning? If you can give a little bit of background, what's the reasoning to why they want to do this capital gains now? And what the change and what the impact that they're claiming that this is going to have on the industry.
So, in short, the intention behind that, is we've seen in the media and the press, is that this is to target the wealthier Canadians who are more likely to realize capital gains. So, and this is impacting the capital gain inclusion rate. That's the big change here that we're talking about, focusing on the capital gain inclusion rate change effective June 25th. So, it's intended to target only a small segment of the Canadian population, because as a related point, the way they've structured it is that for individuals, the first $250,000 of net capital gains will still be eligible for an annual 50% inclusion rate. So you'll still get this first $250,000 at the current 50% inclusion rate. It's only for gains in excess of that, above $250,000. For individuals, will be subject to that higher two-third rate. That being said, all corporations and trusts, subject to certain exceptions for certain types of trusts, will be at this two-third rate. So there's no exception for corporations, which is why this will have a much broader effect than what the government is suggesting it may impact, only 0.13% of Canadians. So that's a little bit of the background in terms of what's been tabled, what's actually as of yesterday, June 12th, the motion to actually implement these changes has passed. So it is now becoming on its way to becoming tax law in Canada.
And you said this is going to affect properties. Now, obviously, there's a primary residence exemption. So this is just on alternate capital gains that are going to be paid to Canadians.
Correct. So on a positive note, the government in their background are actually stated that the principal residence exemption will remain intact. So no changes to one's principal residence exemption. So that continues to be eligible for tax-free treatment on the sale of one's home, their principal residence. But as you mentioned, for other capital properties, so whether that's a portfolio, whether that's a secondary property, your cottage, rental property, if you have shares in a business, this is where there could be more broader capital gains that could be applied to those capital properties. And that could be, the thing with capital gains is that they tend to be lumpy in nature, meaning someone may not, for example, if someone has a cottage, they've held that cottage for 20, 30 years, and they're not necessarily wealthy, but they have a cottage property, and now there might be a very large gain. And at the time of that sale or the time of their passing, where there's a deemed sale, that capital gain probably will be in excess of $250,000. So now you have basically changed the rules, so to speak, mid-game, and now that gain may be subject to a 2/3 inclusion rate. So that does affect more Canadians than just 0.13% of the population, is part of the concern of how these changes are being put forward.
I know that my wife's uncle owns property up near Perth, and one of the guys was down the way from him. He bought the property. I think he had 5 acres of property on the Big Rideau Lake, and he purchased it in like 1970 for basically a song and a dance, because it was not developed land at all. And then sold it last summer because he was like, I don't know what's going to happen, but I'm just going to sell it now. I'll make a huge amount of money. Like COVID really bumped my profit up. The average cottage property, I believe, is 60% was pretty much the raise that went up in 2019 for value. So if you've got a property, like you said, that have had 20, 30, 40 years in the family, I think that people are going to make changes. I know that it's not to the 25th that people are now worried about selling. If they were going to make a decision to sell now, they're looking to sell by the 21st. Like they want to close on the 21st because but the legal hiccups or the bank or whatever could happen to push it past that 25th date, and all of a sudden now you're hit.
So, and if I may, Matt, just to give some more color to that, there was a lot of submissions to the government by different professional bodies to say, without getting political, saying, okay, if these changes, whether they're good for productivity, etc., from an implementation standpoint, perhaps there's ways that this could be modified. So if we are going to increase the inclusion rate, there were calls to potentially say, let's push these changes to December 31st. So it would align with the individual's tax year end, or potentially just give the individual the opportunity to simply elect in their tax return to say, I deem to dispose of this property at this old inclusion rate, versus actually having to, as you noted, actually trigger the gain, to actually sell the gain before this artificial June 25th date. Because many times they might not, if you have a sale, or if there was a sale that was pending, like an agreement, but they couldn't close it for whatever reason, whether it's real estate or sale of a business, would there be ways to grandfather that? So there were submissions for that. There was also a request for the $250,000 exemption. Maybe you should be able to share that with your corporation. There's other rules where you can share certain tax attributes like the small business deduction with your associated corporate group. So those are all, in my view, reasonable submissions. Unfortunately, government decided to dismiss those submissions. So that's where we find ourselves. And that's what the June 10th Notice of Ways and Means motion is basically effectively unchanged from what was originally outlined in the April 2024 budget. And that's what's being implemented. So that's where we find ourselves. And to your point, if someone has a transaction, they actually need to have that sale, like that closing of that sale, before June 25th, if they want to lock in the tax benefits to crystallize that gain at the current 50% inclusion rate. There's no election. It actually has to be a real transaction closing before June 25th in order to get the 50% rate. After June 25th, for individuals, still the first 250 will still be at the 50%. But if you have that gain after June 25th and your gain is beyond $250,000, you will be subject to that 2/3 rate in most cases.
So let's go back to the lifetime capital gains exemption. You said that was a very positive step for small businesses. What is the impact on the small business going to be for this exemption, and how is that going to be affecting like that group of the population that obviously the government is concerned about because they want to hit the top earners, not the middle earners, right? So
yeah. So just to take a half step back, if I may, Matt, a few points. So for business owners, there were some welcome announcements in the budget, the 2024 budget. So one is, as you alluded to, increasing the lifetime capital gains exemption limit to 1.25 million for, I think, the next 2 years, and then it's going to continue to be indexed to inflation. So that's good because now you can shelter more capital gains tax-free. And I'll come back to that. Another thing was the Canada Entrepreneurship Incentive, which is much more targeted, narrowed, new regime, which is basically going to, over time, allow certain business owners, mostly in the technology space, to basically claim a reduced capital gain rate on certain qualifying share sales. There are also changes for employee ownership trust. This is another relatively new concept. So there were certain generally positive things there. To focus on the lifetime capital gains exemption, so why it is now that much more valuable is because not only did they raise the rate from it was like 1.016 million this year to 1.25 million for dispositions after June 25th, share dispositions, qualifying share dispositions, but because the capital gain rate is also going up from 50% to 2/3, there's more value to that. So if before roughly a capital gain exemption of $1 million would save you roughly $250,000 of hard taxes, like actual tax savings per individual who could access it. And in certain cases, you could multiply that exemption with the higher exemption going up to 2/3, with the higher LCG limit going up to 1.25, plus the capital gain rate going up to 2/3, because the capital gain rate is higher now. It's actually worth more like $420,000 of tax savings if you can exempt 1.25 million from a 2/3 inclusion rate. So that's where, once again, as advisors, business owners in particular, where they may have a saleable business, it becomes that much more pressing to work with the tax advisors to put in the right structures, to make sure that if there is the opportunity to potentially have the ability to access the lifetime capital gains exemption on a future exit or deemed liquidity event, we want to work and we want to put those structures in place, or at least consider putting those structures in place, which may involve utilizing a discretionary family trust to potentially multiply that lifetime capital gains exemption. But obviously with the higher exemption combined with the higher tax rate, it becomes, there's more tax, like an absolute tax benefit of having that ability to structure your affairs in such a way to utilize that.
Now you went on, you have an article here on advisor.ca.
Yes.
where you mentioned on this, and you kind of, let's talk back to that election. You had said like
Sure.
They need to allow an election to pay the tax for the accrued gain, and your quote was that it would be nice from a fairness standpoint for people who may not have access to professional advice to engage in transactions before June 25th. You want to elaborate on that a little bit more?
Yeah. So basically, as I alluded to earlier, there were different submissions from different professional bodies to the Department of Finance in light of the fact that these capital gain changes had been announced, but we did not have draft legislation. We had a few paragraphs in the federal budget saying this is what the government is thinking of introducing, but we didn't actually have any draft legislation to chew on. So one of the suggestions was to say simply that instead of actually having to make taxpayers dispose and sell properties before June 25th, just like in 1994, a taxpayer could have simply ticked a box on their tax return and say, I elect to dispose of this at 50%. And that would have made things a lot easier. And especially because the government is saying this is for fairness, like to promote intergenerational fairness. So from a fairness standpoint, because not all Canadians have access to the same level of advisors, professional advisors, tax advisors, etc., it would have been nice if the government would have listen to that request to say, when you file your tax return, you can simply elect to say, I dispose of this property at the 250 rate or at the 50% inclusion rate, versus actually having to undertake a transaction to truly liquidate and sell the property before June 25th. And unfortunately, like in the backgrounder, this is what the government had said. They said tax elections or on-paper realizations. They say a capital gain is normally realized on the disposition of a capital property. With limited exceptions, this requires the taxpayer to legally transfer their interest in the property to another person. The current income tax rules do not permit taxpayers to elect to realize a gain or loss on the property without an actual transfer, and the government does not intend to introduce such an election. So they heard us. They heard what the tax community had suggested, which personally I think is a reasonable request, but unfortunately they decided against proceeding with that suggestion. So that's what the importance here is. If someone is planning to crystallize gains to lock in the current 50% inclusion rate, they actually have to have a legal transfer. They have to sell the property. They have to dispose of it prior to June 25th.
A lot of changes coming down the pipe. Obviously, this is big, and even speaking to other advisors too. They one comment I got from another advisor about this was that the big talk is about cottages. That's what everyone says about cottage, because that is the tip. Let's just say prototypical, especially in Ontario. That is a prototypical like family wealth that you have a cottage, you pass it down to your kids, etc.
Correct.
There's a change in our population because of different shifts. That may not be the biggest thing that's going to impact anymore. And he was alluding to the fact that there are immigrant families that have come over, that may be first or second generation, and they have multiple homes because they will buy, like, you know, the patriarch or the matriarch will buy a few properties, and then the family lives there. And now when they go to move those properties to their children or their grandchildren, now all of a sudden, instead of just one cottage, there might be 3 or 4 houses being moved. And so he was like, this is going to be impactful for a long time going forward. This is going to be we're not going to see a lot of the fallout for this. And he's like, it'll be interesting to see demographically where the biggest impact actually lands.
Correct. And that's why I think, to my earlier point, the government has been saying this is only going to affect 0.13% of Canadians, but I think it will actually affect a much broader segment of the Canadian population, because if they're holding multiple properties, you can only claim the principal residence exemption on one family unit. So you could find yourself, if there's multiple cottages or multiple family homes, as you just described, or rental properties, etc., there could be those lumpy gains where someone's passing away or during their lifetime, they're selling that property. And now it's going to be a higher tax rate. Many cases will be at that 2/3 inclusion rate, 67%, versus at 50%. So, and that may change. Once again, we don't know, because a future government could come out, and this is part of that whole game theory and speculation that we as tax advisors love to speculate, that they might change it. The next government could bring it down, but I wouldn't be betting on that, because it's a lot easier to collect the tax revenues and blame your predecessor. So, but it has moved. So just as an aside, like, it's been 2/3, it's been 75%. We've been at the 50% level since 2000. So, you know, it could go down, but at least as of today, we're expecting to go up to 2/3 in most cases.
How are these changes going to impact any policies, like any existing life insurance policy? What's this going to have an effect on this? So obviously we've talked about land and like how land ownership is going to change, but with life insurance policies, will there be any impact on some of these policies down the road?
Yeah, so great question. A few points. So in short, the short answer is there's no direct change to the taxation of life insurance as a consequence of this. But if anything, it makes insurance planning, like particularly permanent insurance, where there's tax sheltered growth, for corporations, what's called the capital dividend account, CDA credit, that much more attractive and compelling, because now you have a higher tax rate. So your liquidity needs on death, your tax bill is going to generally be larger. If you're passing away after June 25th, your tax bill will be larger. So your liquidity needs will be larger. So any existing insurance becomes that much more valuable to keep in place. And now you also may need to revisit your existing estate planning needs. So to your earlier comment, Matt, now it's a great opportunity for advisors to reach out to their clients to highlight this change in the tax system and make sure that clients don't have any gaps. Because, for example, a client may have done what we call an estate freeze. They may have funded that tax liability as proper succession planning process. And as a result of these changes, if you funded a tax bill when it was a 50% inclusion rate, if someone passes away on July 1st, your tax bill has now gone up from 50% to 2/3. So they may actually be underinsured. So as an advisor, it's important to touch base and make your clients aware and informed of how these changes may impact existing structures. So that's one thing to be aware of. And just on a second note, corporate-owned life insurance itself, in the corporate setting, the CDA calculation, the capital dividend account calculation, on a good note, it's not impacted by these changes. So in general, if a corporation has a capital gain after June 25th, 2/3 of the capital gain will be the taxable capital gain, and 1/3 will be the non-taxable capital gain that gets credited to the CDA pool. Life insurance, the proceeds in excess of the policy's ACB, adjusted cost basis, that is unchanged. So that still is a separate notional bucket that gets credited to the CDA bucket, so CDA account. So that's still very much intact, and will just make the benefits of that much more advantageous, especially if you were comparing it to corporate investing in a taxable vehicle. So it makes it much more important to revisit one's estate planning to make sure they're aligned with the new tax system, this new tax landscape we'll be facing.
And how is that going to then, if people have built these policies in place and they've already done the pay into the tax shelters, if I was your client, what would if I come to you asking, like, what is this going to impact me and how is this going to impact the policies I currently have in place? Like, what should an advisor be aware of with these changes that they need to be looking for? Like maybe a commonality of things that they need to be looking at specifically.
Yeah, no, great question. So in short, as I mentioned, the existing policies effectively, they're unchanged. So directly no changes there. But what could be a gap now, and this is what the advisor should be looking for, is understanding from a first principle standpoint, what was the purpose of that policy? For example, was the purpose of that policy to fund a known tax liability or a known obligation, whether it was, someone's passing away or planning, someone will pass away, and we've done that estate freeze, and we did the insurance with the intention to provide liquidity when it is needed, potentially on the second spouse's death, for example, joint last die coverage. So if the intention was to fund that tax bill of X, but now X is that much higher because we're at a 2/3 inclusion rate, this is something where the advisor should be alert to that this liquidity need on death is now that much larger because the tax rate is higher. So it's hard to say in a vacuum, but knowing your clients, knowing their structures, if they had tax liabilities which may be larger as a consequence of this higher capital gain inclusion rate. So that's where it would be important to reach out to your clients and just alert them to the fact that what they had planned originally may not be sufficient anymore, and they may need more coverage. They may need to sell other assets. They may have, for example, planned to use insurance to fund a tax bill, and then they would have given other amounts to charities, but now their tax bill is higher, so maybe there's less to give to charity. So if there's still a charitable bequest, maybe it's looking at doing other ways to give, whether that's during their lifetime or upon death. So maybe it's now looking at using insurance as a way to amplify their charitable gifting and legacy wishes. So it will depend on the client's wishes and circumstances in that regard.
Now, capital losses, if they're realized previously to the 25th, you can still apply them post 25th, correct?
Correct. So briefly, that's correct. And the government, on a positive note, as I understand it, is going to adjust the inclusion rate. So if it's at a 50% inclusion rate when you're carrying it forward, I think they're going to adjust it to the 2/3 rate. So it will still have the same value as I understand. So that's positive. That was as an aside, just to take a half step back. Part of the challenge, like we're recording this on June 13th. It's only on June 10th that we actually had the legislation. So, and they gave this 10-week window from April 16th to June 25th. And really in the tax community, we were all speculating on how these changes would apply. So I was at a STEP conference last week, Society of Trusted Estate Practitioners, and the reality is there were a lot of unanswered questions in terms of how these rules will apply. How will they apply to trusts? How will they apply to capital gain reserves and other areas? So on a welcome note, we do have more certainty now that we have legislation. So on a positive note, that has been addressed which we welcome. Like, it's good to have certainty so you can advise your clients appropriately. Whether they need to take action before June 25th, we actually have legislation as of today, which is good news.
That is very good news. It's nice to have that for sure. Because I mean, I know even before they tabled it, there was a lot of people that are going, well, like they're saying it's going to go to this, but whether it goes to that or not is a different thing. And when it goes to that is the other part. It's like, so now we know it's like on this date, this is what it's changing to.
No, just to pause on that too. Not only that, like we've had client discussions where this year alone, from a implementation standpoint, there's been different, we'll say, fiascos where like there was what's called the underused housing tax, the Bear Trust fiasco, where at the last minute, the government had these changes and then they, by press release or other means, they said, actually, we're going to change our minds. So we're not going to make these rules come into effect. So we've had client discussions and there was the concern. What if we're doing all this planning, we're going to crystallize gains before June 25th? What if at the 11th hour they say, we're not going to do this and we're going to push it back, and which is valid concerns. So at least as of where we are today, we have legislation. The motion has been voted on to move forward. So the rules are what they are, but at least we know how we can plan our clients' affairs accordingly with working with the client's tax advisors and the collaborative fashion with their team of advisors. But so it's good to have that comfort that we know what's coming down the pipe.
And what are you seeing from your side? Because you deal with a lot of high net worth individuals. So what are you seeing from your side of the business? What are your clients saying to you when you're meeting with them about this? Maybe even like new clients that are coming to you saying like, hey, like I'm looking to get into this, or I'm looking to add a policy, but like, how is this going to affect what I'm going to be doing in our planning going forward?
Yeah, so a few general comments. Firstly, obviously, in general, clients are not too happy about the inclusion rate going up. So with, there's the concerns around this. There's been clients who are saying, I'm fed up, I want to leave the country. That's also been talked a lot about in the media, et cetera, which I think people may generally talk about it. But in my experience, a lot of the times they'll decide to stay versus becoming a true non-resident of Canada and giving up your Canadian residential ties, et cetera. So that's been certainly a frustration, a pain point. But then provided the clients are deciding to stay in Canada, it is unfortunate because it is also in a way a retroactive tax, because the way this is being introduced, there's no valuation day, there's no V-day, there's no like you're taxing all this unrealized growth. So that is also frustrating, especially with clients who have corporations. Like you look at the medical professionals where they have their medical professional corporations, there's a breakdown of what we call integration or disintegration, because now it will cost you more to realize capital gains corporately, where the corporation does not have that first $250,000 reduced 50% inclusion rate, versus if I'm realizing that gain on a personal basis, where I do get that 50% inclusion rate after June 25th. So it's part of it is understanding how these rules will apply in the given client's specific circumstances. So that's part of it. And then secondly, it's also just understanding why we're proposing the planning. A lot of the planning we're doing, it's really either to fund tax obligations on death. And once again, this will continue to be that much more important given the tax liabilities are expected to rise, because in the year of death, now you may be looking at a 2/3 inclusion rate versus a 50% inclusion rate. So it's very important for advisors to work with the clients, work with their accountants to model their tax bills on death in light of this higher inclusion rate. So that's something that we're speaking with clients about. And then another way we look at it is, which LDA has an excellent tool that I use commonly to show what we call an estate bond type concept, where you're looking at insurance as a tax advantage alternative asset class, your corporate estate bond, for example. And in those cases now, in light of the higher inclusion rate, the tax sheltered growth of insurance is going to be that much more compelling, because now you're taking assets that would have been in a taxable account, may have been subject to 2/3 inclusion rate. You're repositioning that to tax sheltered vehicle, tax sheltered growth, tax-free payout into the corporation, CDA credit, which is not impacted because CDA has a separate bucket. The life insurance proceeds and exit the policy's ACB. So it makes the insurance that much more significant and provides that much greater value. So it's understanding the clients and reaching out to the clients to understand where there may be gaps and planning opportunities, and then providing them with the appropriate solutions accordingly, I would say.
I appreciate you coming on today, Henry. This has been a good a lot of in-depth facts talk, which is something we don't do a lot of here, because obviously with life insurance, but it's an important thing, especially when we're talking about life insurance as an asset class and how you can use this to like structure your generational transfers of things, especially with the estate transfers. So thank you very much for coming on. I appreciate it. Second time.
Thank you for having me, Matt.
Just as good as the first. Yes.
Thank you. I appreciate it. Always a pleasure talking tax.
Thank you very much for coming. Are you tired of paying for leads that just don't deliver? Say goodbye to ineffective lead generation methods and discover the power of LDA Lead Gen. Transform your website into a powerful lead generation tool and start capturing high-quality, tailored leads today. No more paying for each lead, and LDA Lead Gen is a cost-effective solution at only $20 a month on your LDA subscription. Your prospective clients will start by filling out their name and where they live, as well as why they're trying to find insurance, whether that be having a baby, buying a house, going to school, or cottage succession. After this, LDA will notify you of the opportunity and will provide a tailored presentation as a starting point for the conversation with your new prospective client. If you want to learn more information about Lead Gen, go to www.lifedesignanalysis.com/lead-gen. That's LEAD-GEN. I'd like to thank Henry Korenblum for coming on for the second time to Policy Pod by LDA. It's always a pleasure being able to talk to Henry and his in-depth wealth of knowledge regarding tax laws in Canada. Before we end today, I again want to encourage you to join our LinkedIn group, Policy Pod by LDA, as well as if you've never tried life design analysis before and want to see how it will affect your life insurance practice, you can sign up at lifedesignanalysis.com/sign up. That's lifedesignanalysis.com/SIGN-UP. Before I go, I would like to remind you that we made this podcast as a place to foster conversations that matter to you, our listeners. With that said, if there's a topic or an area of expertise that you would like to come onto the podcast to discuss with us or would like us to explore, I want to hear from you. Connect with me on LinkedIn or send me an email at marketing@lifedesignanalysis.com to lend your insights and experience to the conversations on PolicyPod. Thank you again for joining us today. We look forward to having you in our next conversation. Have yourself a wonderful day.